The ETF industry is exploding and it provides investors with a unique way to potentially capitalize from the markets in a passive way, with limited risk. In this video, I'll explain how to do a proper step-by-step analysis in an easy manner and a quick manner as well. This will bring your level of financial knowledge to an absolutely new level. As always set with educational purposes and should not be considered to be financial advice. It is best to start with an explanation of the differences between an index and an ETF. Due to the fact a lot of people do not understand the difference, and it is quite basic. An index tracks the performance of a certain asset or group of assets. We cannot invest in an index as it is only a measurement of price levels. If you want to have an allocation into these certain assets behind an index, you must buy an ETF which tracks the performance of this exact index we are interested in. For example, the S&P 500 index just tracks the performance of the 500 largest publicly traded companies, but we cannot invest in the index directly. If we want to have exposure to the S&P 500 index, we must buy an ETF which mimics the performance of the index. ETFs are established by big financial companies, the biggest of which are two, BlackRock and Vanguard. They have the largest ETF options in the markets. Also, it is important to note that nowadays there are ETFs for absolutely everything, from ETFs which track the performance of a certain group of robotic companies to cannabis companies. There are commodity ETFs, country-specific ETFs, which only invest in Brazilian, American, European stocks and others alike. We could have continent-specific ETFs and so on. If you can invest in something, just know somewhere there in the investing world there's an ETF which this investment could be done through in a diversified way. In general, ETFs offer minimized risk due to their diversified nature. Instead of buying 1, 2 or 3 companies, some investors choose to buy an ETF which is composed of tens or in some instances hundreds of companies. In this way, we're protected in the sense that if a couple of companies fail and go bankrupt, we still have a lot of other investments which protect us. This way we have less risk, but also the returns are lowered. This is because not all of the ETF investments will perform the same. The top picks will do very well, the middle picks will do okay, while the bottom picks will not do so well. If we are an individual stock picker and we know how to do a proper analysis, then our returns could be much higher. But for this, we must be willing to take on more risk, and even more important than that, we must know how to analyze stocks like the greatest investors in the world. Subscribe to the channel and check out our other videos on the channel in which I do just that, teach you the ways of the greats. Now let's start with the step-by-step process for ETF analysis. The ETF I'll analyze in this video is the S&P 500 ETF by iShares. iShares is the ETF wing of BlackRock. Comment down below which ETF you're interested in and I'll try to analyze it next time. The first thing we will see when we open the web page of iShares and we type in the certain ETF we are interested in is the ticker on the top left. The ticker is IVV. If we buy this ticker IVV, we buy the iShares Core S&P 500 ETF. If you're wondering how to buy it, all big financial brokers offer these investments. You just go on their platform, type in the ticker IVV and you will find it. Then a little down below you can see their expense ratio. This is probably the most important thing for you to look at first. In this case it is 0.03%. This is the fee you pay on a yearly basis to BlackRock. Always try to choose the least expensive option because, as Warren Buffett says, these fees are the silent killer to every investor. A fee of 0.03% means that if we invest $1,000 in this ETF at the end of the year, will be charged only 30 cents, which is very little. The more niche the ETF, the higher the expense ratio would be. For example, a robotics ETF or a Chinese ETF would have expense ratios ranging from 0.2% to around 0.7%, which is around 10 to 20 times higher fee levels. After we saw the expense ratio, if we look a bit lower, we'll see YIVV and investment objectives parts. There it is explained the specifics of the ETF in a brief and short manner. After that, there are three parts we must see in a bit more detail: the key facts part, the portfolio characteristics part, and the holdings part, and of course also we must see the exposure breakdown part. Each of these is below the next, starting with the key facts part. Here we must look at the net assets of fund. The bigger this number, the better, as more capital means more trust. The current AUM or assets under management are $287 billion. Then we must see the fund inception. The longer the fund has been active again, the more trust this ensues in us, the investors. In this case, the fund is 22 years old. These are the main parts we must look on this page. Then we must check the portfolio characteristics part. It is very important to check first the number of holdings, as this shows the diversification of the ETF. In this case, we have 503 different investments. Then we must check the standard deviation, which in this case is 20.3%. This is the average yearly volatility of the fund over the past 3 years. This means that on average, during the last 3 years, the index has moved by 20.3%, either to the downside or to the upside. The higher the standard deviation, the stronger the stomach of the investor must be. If a person cannot bear to watch how his portfolio drops by 20 or 30% in a year or even more, then he must not invest in this ETF and he must choose another which is less volatile and has fewer percentage price moves per year. After that, we must check the PE ratio, which stands for price to earnings, and it shows how much on average we pay for each dollar of earnings. In this case, we pay $17.87 for each dollar of earnings of the S&P 500 index, which is above the average over the last 100 years, but not by much. Then we check the PB ratio, which stands for price to book value. Book value is a synonym of equity. The equity of a company is found when from the total assets we subtract the total liabilities or debts, in other words. The average is 3.44, so for each dollar of equity we pay $3.44. It is best for this to be below 3. So from a historical perspective, the current price levels of the S&P 500 are a bit above the norms, but as the great Warren Buffett says, if we have a long-term investment horizon of 20-30 years, there is no better investment for the average investor than the S&P 500 index. After that, we check the holdings part. If we want to be a serious investor, we cannot blindly buy an ETF without taking a closer look at the holding positions. Sometimes an ETF is composed of very overvalued companies, and even if it is diversified, this will not protect us from losses. In the case of the S&P 500 index, it is obvious in which companies it is invested in, the biggest US companies. But this part is very important when we invest in a more niche ETF, like an African or biotechnological ETF, for example. In this case, Apple is the top holding with a 7.03% share of the total ETF. Second comes Microsoft with a 5.71% weight, and so on. Last but not least, we must check the exposure breakdown part. There are 7 investment sectors, and here each sector is expressed as a percentage. The number 1 sector in this ETF is the information technology sector, with a 26.29% share. After it comes the healthcare sector with a 15.03% share, and so on. In order to understand the risk properly, we must know when each sector is doing good and when it is not. For example, in times of monetary tightening, the tech sector, financial sector, consumer discretionary sector, and the industrial sector, as well as the real estate sector, do not perform well. And in times of monetary easing, meaning when the central banks print money and they lower interest rate levels, these sectors perform better. Now we are at a stage of the economy in which central banks around the world are tightening the monetary system due to higher inflation levels. This was the clear step-by-step process and specific things we must look at when analyzing an ETF. Check out our other videos on the channel, as every single one provides you with a lot of value. Make sure to subscribe if you like what you see and hit the notification bell if you don't want to miss out the latest videos. Thank you for watching, and I'll see you in the next one.